Joanne Myers, Director of Public Affairs Program, and on behalf of the Carnegie Council, I'd like to wish you all a very happy New Year. This morning, we are delighted to begin the year by welcoming to our breakfast program a preeminent economist who is also one of the world's leading monetary historians, Barry Eichengreen. Professor Eichengreen is currently Professor of Economics and Political Science at Berkeley. For half a century, the United States has garnered substantial political and economic benefits as a result of the dollar's de facto role as the world's currency. This position has created a great deal of envy, even inciting one French critic to declare that the international dependence on the dollar affords America an exorbitant privilege. Yet, in recent years, the dollar's preponderant position in world markets has come under siege. With the recent financial crisis sparked by the collapse of the U.S. mortgage market, financial bailouts, huge deficits, low economic growth, and low interest rates, many throughout the world are concerned that the dollar may no longer be able to play the role of the main reserve currency for much longer. While it's true that the dollar has become more volatile than ever against foreign currencies, so much so that various nations have switched to no-dollar instruments in their transactions, you may conclude that confidence in the dollar as a global reserve currency is sinking and will soon be replaced by the euro or the Chinese renminbi. But not so fast. In Exorbitant Privilege, Professor Eichengreen counters this argument, challenging the presumption that there is room for only one truly preeminent global currency. While there may be many factors which would support against the future of the dollar as a global reserve currency, our speaker posits that the dollar will lose its preeminent status in international currency if and only if the U.S. continues to repeat the mistakes that led to the financial crisis in the first place and fails to put its fiscal house in order. In other words, the fate of the dollar hinges not on the actions of the Chinese government or the European Union, but on economic policy decisions made right here in the United States. While some may continue to believe that the dollar is doomed, others will regard its continuing dominance as inevitable. No matter what view you may hold, Professor Eichengreen admonishes that in the end, what matters for now is that with exorbitant privilege comes exorbitant responsibility to prevent the international monetary and financial system from descending into chaos. To give us his perspective on the future of our currency, please join me in welcoming our guest today, Barry Eichengreen. Thank you.
Thank you, Joanne. You not only laid the foundation for the talk, but you summarized the book better than I probably can. And thank you to the Carnegie Council. Books at breakfast is a very nice idea, although 5:15 a.m. California time is a bit ambitious for some of us. My book is an attempt to use the economic history to use the dollar's past to try to draw some insights about the dollar's future. Books go off to the publisher, how should I put it politely, somewhat in advance of their appearance. And when you write a book that reflects on possible futures, the possible future of financial markets, you wonder what the state of the world will be at the point in time when the book appears. It was formally published last Friday, and thankfully the dollar is still in the news. Not all that news is good. There has been, since the book went off to the publisher, the Fed's decision to engage in a second round of quantitative easing, and complaints, mainly on the part of policymakers in emerging markets, that this was an overt attempt to debase or devalue the greenback. There is still the specter of trillion-dollar budget deficits extending into the future, as far as the eye can see. There is the soaring price of gold, which, among other things, reflects less than full confidence in the prospects for the dollar. But there is good news as well, namely that other currencies have even more severe problems. The euro at the moment and the dollar has the exorbitant privilege, the phrase coined by Charles de Gaulle's then finance minister, Valéry Giscard d'Estaing, that it's not only America's currency, but the world's. And it's the world's currency to a quite remarkable extent. The dollar, we learned last week from the Bank for International Settlements, which conducts a survey of foreign exchange trading every 3 years. The dollar is involved in, currently used in 85% of foreign exchange transactions worldwide. It still accounts for 61% of the foreign currency reserves of central banks and governments worldwide. Countries like South Korea and Thailand set the prices of 80% of their exports in dollars, despite the fact that only 20% of the goods they ship abroad actually go to the United States. When Somali pirates ransom a ship, hijack a ship, they demand that the ransom money be parachuted to them in dollars. When Mr. Karzai's people get bags full of money, the money in question, of course, is in dollars. This is not, this fact that the dollar is the world's currency is a considerable convenience to Americans. We can pay our taxi drivers in dollar bills in many cities around the world. It makes doing international business easier for American corporations, but it's not entirely an unmixed blessing. Since foreigners want dollars to finance their international transactions, they want dollars to hold as insurance against the possibility that something might go wrong in financial markets. They're willing to lend to us at low interest rates in order to acquire those dollars. So if we in the United States are prone to excesses, for example, if we engage in frenzied real estate speculation, foreigners willingly give us more rope by purchasing not only U.S. Treasury securities, but the securities of Freddie Mac and Fannie Mae. Now, of course, after the financial crisis, we have learned the error of our ways. American households are spending less and saving more. That is a fact. The household savings rate has risen to 6 or 7% of household income. The fact that American households are spending less means that we have to export more of what we produce. And part of doing that will involve making our goods more competitive, making them more attractive to foreign purchasers. We need a somewhat weaker dollar as part of this adjustment, but find it difficult to impossible to obtain that weaker dollar because given the dollar's singular role in the global system, other countries are accustomed to pegging their own currencies to the dollar. And that frustrates America's effort to engineer a somewhat weaker dollar and get on with this adjustment. So you'll be aware that this is a flashpoint in relations between the U.S. and China, and it will come up next week when the Chinese president visits Mr. Obama. But the point is more general. How did we get into this situation? The dollar achieved its position of dominance after World War II, when the U.S. economy, the United States was the only economy standing. The United States was the dominant industrial power. We were the world's largest exporter. We were the only country with deep and liquid financial markets open to foreign governments, foreign central banks, private investors of other countries. So it made perfect sense for people who wanted to hold foreign financial assets to hold dollars and for other transactions in international markets to go through the US dollar. There was no intrinsic reason why Europe, Japan, and emerging markets should remain so far behind the United States. And as you know, the subsequent half-century saw a process of convergence or catch-up where other parts of the world have begun to close the gap vis-a-vis, economic gap vis-a-vis the US. So we now live in a more multipolar economic world, but we still have a dollar-dominated international monetary and financial system. So if you want a very encapsulated description of how I understand the recent financial crisis we've been through and the continuing financial volatility we experience, is that there is this imbalance or this tension between what is now a multipolar global economy, but still a disproportionately dollar-dominated global monetary and financial system. So why is the monetary and financial system so dollar-dominated? The traditional answer is the advantages of incumbency. The dollar is the incumbent global currency. Incumbency is an advantage for politicians seeking to hold on to office. It's an advantage for currencies seeking to hold on to their international status. The argument goes that if everybody else is using dollars for their international transactions at a point in time, it will be convenient for them and therefore convenient for you to do the same thing. If you're a company exporting a particular commodity and your competitors price their goods in dollars, it will probably pay for you to do the same thing, to make it easy for your customers to compare prices. That's what your customer base will be used to. So economists have a name for this situation. They call it a market characterized by network externalities, where it pays to do the same thing everybody else in your network does. So that's the story why the dollar is still the world's currency. And it has an implication that the dollar will remain the world's currency because of the advantages of incumbency. So I want to suggest that this is wrong. It may have been a convincing story once upon a time, but it's convincing no longer. It may have been true once upon a time that only sophisticated traders and investors could compare the prices of different goods or different financial assets denominated in different currencies. But now everybody carries in his pocket or her pocket a device called a smartphone. Now Currency Converter is one of the top 10 downloaded apps at the Apple iStore. So I think that we can all, looking around the room, everybody in the room can remember the day when you bought your first personal computer and you didn't have a choice of operating systems. You had to use the one everybody else used, unless you were a computer hobbyist. If you had an interest in exchanging data with coworkers, you had to use Microsoft's product. But now there's a proliferation of operating systems. Switching is easier, and I think what is true of computer operating systems is increasingly true of international finance. I think we're moving to a world of multiple international and reserve currencies and away from the world in which there was only the dollar. I think we can get there in as soon as 10 years. And I think if we succeed in navigating that transition, the world will be a safer financial place. There will be a better balance between the multipolar real economy and what will then be a multipolar monetary and financial system. And because there will exist alternatives, the discipline on market discipline felt by countries like the United States that issue one of these reserve currencies will be stronger. If we do things that alarm international investors, they will have alternatives. And that kind of market discipline, I think, we have learned from recent experience can come in handy. So you will be asking at this point, what currencies specifically am I talking about? If you ask me, what will the important international currencies be 10 years from now, I would answer the dollar, the euro, and the Chinese renminbi. So I'm sure people around the room will pause at this point and say, one of those currencies is clearly not ready for prime time, and it won't be still 10 years from now. The problem being that people at different tables will object to different ones of my three candidates. So let me say a few words about each of them. you will know that pessimism is greatest at the moment about the euro. It's not clear that the crisis countries in the euro area being forced now to impose draconian budget cuts can recover without reintroducing their own currencies, or so it is argued. Keeping them in the euro area would require massive fiscal transfers to the crisis countries from Germany, and German voters would rather abandon the euro and reintroduce the Deutschmark than go for that, or so it is argued. You will anticipate, given what I've already said, that I think this euro doom and gloom is overdone. Some historical processes are very hard to reverse, and I think the movement to create a currency union is one of them. I'm not ruling out that there could be more serious financial problems in the euro area, and I personally attach quite a high likelihood to the possibility that Greece or Ireland or another euro area country will have to restructure its government debt, engage in what people offhandedly refer to as a debt default. But just like a default by Nassau County would not mean the end of the dollar, a Greek default would not mean the end of the euro. And I would argue quite strongly, I'll leave it for the Q&A, that for a country like Greece, to at the same time reintroduce its own currency would only be making its problems worse, doing even more damage to its banking system and to investor confidence. Germany is the one country that could, in principle, abandon the euro without precipitating a very grave financial crisis. But I think there are compelling political reasons and compelling economic reasons why it would never do that. Germany has too much invested in the European project. I personally think this talk about a new generation of German leaders having a very different attitude to that about the European project is overdone. And Germany's economic success in the last 10 years can be summarized in one word: export. And that would be very, very difficult with a Deutschmark that would go through the roof against the rump euro. The German business community is still very strong pro-euro because they understand on which side their bread is buttered. So Europe, I think the euro is here to stay. It is clear that Europe has a lot of work to do to complete its monetary union, to put the crisis behind it. I can talk about the specifics later if you want, but the crisis has now come to the point where European policymakers now understand exactly what needs to be done, and now they have to forge the political consensus to do it, I think, between now and their summit at the beginning of February. Jean Monnet, the father of European integration, said that Europe is forged in crises. More recently, Jacques Delors, the father of the single market, said Europe has to rediscover its soul. I think the crisis will make Europe realize it has to go forward or it will go back, and as it has at each similar juncture before, it will go forward. And one of the things it will have to do is issue limited amounts of e-bonds, bonds backed by the full faith and credit of the entire collection of euro area countries. And that will be a first step toward creating the deep and liquid treasury bond market in Europe that will ultimately be similar to the deep and liquid treasury bond market that we have in the United States. So that's the euro. Let me say a few words about the dollar, which may be what brought you out this morning. The challenges facing the dollar, as Joanne said, I think are fundamentally fiscal. What alarms international investors is the prospect that we will let our sovereign debt, our government debt, run out of control, And when they look deeper, they are worried, just like many Americans are worried, about political polarization, dysfunctional politics, and the inability of the parties to work together to bring this problem under control. Our federal government debt is approaching 75% of national income. For a federal government that only raises 19% of national income in taxes, in a good year, the tax take goes down in recessions. Servicing the kind of debt load that we already have is a formidable task, or at least it will be when interest rates go back up to normal levels, as they eventually will. So I think that solving this problem will require the parties to acknowledge that there is no single solution to the budget deficit problem. It can't be fixed simply by cutting spending. There will have to be what we might euphemistically call revenue enhancement. There will have to be more taxes of one sort or another, and there will have to be completion of the process of bending the healthcare cost curve, because it's healthcare expenses that will make the budget deficit really explode going forward. If foreigners don't see progress along these lines, they will conclude that the U.S. will end up having to resort to expedients. We will inflate away the real value of the debt. We will withhold payment of interest on government bonds, or resort to some similar expedient rather than cutting essential public services. Foreigners can solve this problem forward, and they would try to get out of the way before the worst occurred. So that's the scenario in which there could be a dollar collapse, a dollar crash, a dollar crisis, which would mean mass flight by international investors, public and private, away from the greenback, which would be costly to, obviously, to the United States. So that's not my baseline scenario. The United States has faced and dealt with formidable challenges before, but this is something to worry about, a scenario that serious people ought to ponder. In the book, I wrote something to the effect that the United States has maybe 5 years to get its fiscal and financial house in order, and I must admit that I've grown more pessimistic since then. Economic history tells us that financial crises occur around the time of elections. Lehman Brothers occurred right before a presidential election, when it wasn't entirely clear who held the reins of policy and who could move, and uncertainty about what would be next was pervasive. So I don't know that I've grown so worried now that I think the end of 2012, beginning of 2013 is when it's possible the worst could occur. But I think serious people should think about this. Finally, there is the third of my three candidates, China's Yuan or renminbi. China has a lot of work to do in order to complete the process of internationalizing its currency. China understands that, and it is working very hard. It is moving now very fast to complete that process. Chinese policymakers understand that it would work to the advantage of Chinese firms if they could do business in their own currency, and they didn't have to incur the expense of having to buy dollars when they wanted to export or import, that Chinese banks would benefit from having a slice of international financial business. And they could do that more easily if their own currency was freely traded. So you will have seen either yesterday or the day before that the Chinese authorized one of their big banks, the Bank of China, to begin to provide foreign exchange trading services to Americans, to open up renminbi-denominated bank accounts in New York. You may have noticed that the a share of bank accounts in Hong Kong that are not in Hong Kong dollars, but in Chinese renminbi, quadrupled in the last year. China went in the last 12 months from a position where basically none of its companies did their import and export business in China's own currency to a point now where 70,000 Chinese companies are doing that. They're now something on the order of 50 dim sum bonds denominated in China's own currency, issued by companies like McDonald's and Caterpillar and a variety of others. So a lot of this business is still being done all of it basically is still being done in Hong Kong, right over the border from China. But Hong Kong is their petri dish for cultivating these practices and testing them out. I think what is happening in Hong Kong now will be done in Shanghai 5 or 10 years ago. So the Chinese have to do lots of things. They have to strengthen their financial system, strengthen confidence in their financial system, strengthen rule of law. If they open their markets to financial inflows and outflows, they will need a more flexible exchange rate as a buffer or a cushion against capital flow volatility. But I think they're serious about doing that. They've set a deadline of 2020 as the date by which they will have transformed Shanghai into a true international financial center. And if and a corollary of that would be greater international use of China's currency. History also suggests to me that this kind of rapid transition is possible. The history of my own country suggests that it's possible. So the United States went from a position where the dollar was not used in international transactions at all in 1914, actually to a point where the dollar had overtaken the pound sterling as the leading currency for trade invoicing, for the issuance of international bonds, and as a form of central bank reserves already in 1924. Now, I will acknowledge that other things intervened between 1914 and 1924 to weaken the position of the dominant international currency, the pound sterling. But we in the United States, people like Senator Nelson Aldrich from Rhode Island and Paul Warburg, the New York banker, were expressly interested in enhancing the international use of the dollar in order to advantage American corporations and American banks. That was one of their motivations for supporting the establishment of a central bank. The Fed was founded in 1914. The Fed then set out to create a market in trade credits and other foreign investments in dollars, and it had succeeded in 10 short years. So I wouldn't disregard the possibility, I wouldn't dismiss the possibility that the Chinese, who are intent on achieving the same by 2020, will succeed. So the dollar, the euro, the renminbi all face challenges either to hold on to or to acquire international currency status. But I think the fact that that there are questions about all three suggests that none of them will necessarily be dominant and that there is room on the international stage for all three of them. What will this mean for Americans, and what will it mean for the international system? I do some calculations in the book about what the implications for American living standards and American incomes would be if the dollar lost its exorbitant privilege entirely. And the kind of numbers I come up with are that would cost us $225 billion, 3% of US GNP. That's 1 year of normal economic growth. So it's not a catastrophe, but one would feel it. We would feel it in the form of higher borrowing costs, higher funding costs for the government, because foreigners would no longer be absorbing the majority of the treasury bills and bonds that we issued. If the government had to compete compete at higher interest rates for funding. Others, corporations and home buyers, would face higher interest rates. The dollar would be somewhat weaker. You would see higher prices for flat screen televisions at Best Buy. So again, it's not a disaster from the point of US living standards, but 3% of US GNP is 1 year of economic growth. And we've had a recent reminder of how much better people feel when the economy is growing than when it isn't. That kind of change would be felt. On the other hand, I do think that moving toward a system where there are multiple international currencies would help us in terms of dealing with some of the sources of financial volatility that we've seen recently, as I explained. There would be more discipline felt by the reserve currency issuing countries. Other people object that the kind of system I've described could be dangerously unstable, that with the dollar and the euro and the renminbi all being important reserve currencies, central banks and governments, if they perceived the existence of problems with one of those countries, could easily switch into the others. The problem currency would collapse, the others would go through the roof, exchange rates would become dangerously volatile. I don't believe it. I think central bank reserve managers don't act the same way as hedge fund managers. They're not compensated. They don't have the same high-powered incentives. They're not compensated on a 2+20 basis. They don't have to exceed the previous high watermark in order to draw a paycheck. They have social responsibilities, and they know it. I have, by this point, talked to a lot of them. They have patient, they're investors. Their principles are more patient than those of hedge fund managers. Central bank reserve managers have guaranteed funding. They find it easier to act as contrarians when everybody else is panicking and selling a currency. They can step in and buy it and stabilize the otherwise unstable exchange rates. And that seems to be what the data show. If you want a recent example, in the third quarter of last year, the dollar was relatively weak, and central banks around the world bought more than $100 billion worth of dollar bonds that same quarter, acting in effect as stabilizing speculators and rebalancing their portfolios. So I am ending, if you will, on a high note. I'm not entirely a messenger of doom and gloom. If you buy my argument, then you should see our current difficulties as a reflection of the imbalance, the existing imbalance between our increasingly multipolar international economy and our still dollar-dominated international monetary and financial system. So the good news is that this is a problem that should solve itself over a period of, say, 10 years, if we can safely get from here to there. The bad news, of course, being that history teaches us that financial crises of one sort or another occur about every 3 years. So I'm happy to take some questions.
Thank you for a very clear analysis. I'd like to open the floor to questions, and I just would like to ask you to wait until the microphone comes to you, and please identify yourself. Don?
Don Simmons is my name. I enjoyed your talk, Professor Eichengreen. For decades, I think, New York State has sent more tax dollars to our national government than we have received in benefits. Mississippi has experienced the opposite flows. Every few years, there's an article in the newspaper where this is all laid out for us to read. New Yorkers' reaction to that, I think, is nothing more than a shrug. We don't really resent Mississippians. We feel lucky that we have higher income. Seems to me that Germans would have to have that feeling about Greeks, to pick those two countries, in order for them to be prepared to take on what is an indefinite responsibility of subsidizing the residents of that country. Would you agree with that? And then do you think that is likely to happen?
I would agree that that the extension of those kind of transfers or subsidies indefinitely is implausible, partly because that sense of identification as Europeans, you know, we are all Americans whether we live in Mississippi or New York. The same sense of identification at the European level doesn't exist. I would suggest, however, it increasingly does exist among the young as a result of airline deregulation and the fact that everybody is using Ryanair and the like to go to secondary cities around Europe on weekends. It really is a different story for the young. But I seriously, I take your point, and the way I think about the answer is that these transfers will not continue indefinitely. Greece is really getting tough love at the moment, and any transfers that will occur now will be predicated on, they will be conditioned on cleaning up the mess in such a way that there is a clear terminal date to the assistance. There, you know, you clearly read about the debate in Germany, and I'm sure you will have read that Mrs. Merkel and other German politicians have said in no uncertain terms that any assistance will be conditioned on real reform and without, and that is true of the existing limited IMF EU packages for Greece and for Ireland. They are doing the kind of fiscal reform that we in the United States have not yet begun to talk about.
Yes, I'm Jim Robbins. One day last year in this room, we heard two authors speak about a book they had written, which you might like to comment about, if you will. It was This Time It's Different by Rugoff and Reinhardt, in which they speculated that the amount of debt that had accumulated both privately and in the public domain was irrevocably large, and that the only solution for it was to be an inevitable crash of some kind. And they claimed also to have studied economic history and developed their theories of finding particularly data that supported their ideas about the frequency of crises. And since you have just mentioned the same thing, I'd be interested to hear your reactions to their ideas.
I'm an admirer of the Reinhardt and Rogoff work, and you know, you're quite right to bring it up. The two books, The Three Minds, are not entirely independent of one another. So their data set draws on earlier research that I did with a co-author on the incidence and frequency of banking and currency crises. My book, which is mainly words rather than tables, that may be one of the main contrasts with theirs, in turn is influenced by their ideas. I think the notion that we will inevitably experience a fiscally driven crisis in the United States is too strong. I think it's entirely within our economic capacity to draw back from the brink. There's no reason why we have to deal with the debt that we have already incurred in a disorderly, opportunistic way. But, you know, I just said it's entirely within our economic capacity to do it. The problem, I think, as with almost all financial crises, has a political dimension as well.
John Hirsch, first of all, thank you very much for your remarks and your rather upbeat assessment of the prospects for the future. I was struck by the phrase you used about the United States early on in your remarks. You said, "We have learned the errors of our ways." And you, I think, referred specifically to consumers saving more than previously. But what about more broadly the Congress, the administration, the Wall Street, as it's called, the banking system? You know, there are a lot of comments that suggest that people have not learned the errors of their ways, that there's still an inclination in Wall Street to go into unreasonable speculation to risk, in other words, the economy of people here. Could you comment on that?
Well, I should, when I am being sardonic, I should raise my eyebrows more visibly. I think the recent financial crises, as all financial crises, had multiple causes, multiple roots. One of them was the credit boom that led to both the real estate bubble and the fact that households stopped saving. There has been a deleveraging, a drawing down of household debt, and a rise in household savings that data and economic analysis suggest are permanent. So those are good things. But there are plenty of other problems that we haven't solved, and plenty of other errors that we haven't corrected. To my mind, financial reform is at the top of that list. I think what we succeeded in doing in the form of the Frank Dodd bill was better than nothing, but not a whole lot better than nothing for a variety of reasons. So the fact that we still have a set of very large, highly leveraged banks that remain too big to fail continues to create all kinds of problems of skewed incentives in financial markets that can come back to haunt us again in ways that are not so similar to what happened last time. The fact that there are still lots of derivative securities that are traded hand-to-hand, traded over the counter, rather than through clearinghouses, means that problems of counterparty risk, if bank A fails, it topples the whole set of dominoes. Those problems are still there. So yes, I'm worried about all this, and problems in financial markets could be another precipitant for doubts about the dollar.
I'm John Richardson. From the point of view of economic history, this is my question. When you look around the world, it seems to me the tendency is for mature economies to just run lousy public finance, and they're in debt. Japan is probably the worst example in the public debt level. France is terrible. The United States is catching up to France. Is it possible that this can go on? Is this going to lead to just we disappear in a whimper, or is it going to produce a right-wing reaction, or what? Is there a historical precedent or some sort of guidance that you can suggest?
Well, Herbert Stein, who was one of Nixon's economic advisors, famously said things that can't go on forever generally do not. It can't go on forever in that sense. There has to be a relationship between the rate of growth of the debt and the rate of growth of the economy for the debt load not to just explode out of control. Mature economies, the rate of growth of mature economies tends to slow down. That makes it important even more important to bring those financial problems under control. The United States has had the exorbitant privilege that foreigners would buy our debt and demand interest rates that were lower than what we could earn on our own foreign investments. So that enabled us to issue more debt than we would have had to otherwise, and I'm suggesting that that privilege will, at least in part now, go away. So, I can answer that first part of your question. The second part, exactly how will it play out if the government finds itself in a position where it can't both maintain interest payments on the debt and provide essential public services? Which do you think our leaders will opt? Which contract do you think our leaders will opt to honor, and which one will they abrogate? I can't yet give you what the movie screenplay would look like. But, you know, there is a general class of dark scenarios there that could develop.
Richard Valcourt, going back to Mr. Simmons's question at the beginning, both the United States and Chinese currencies are based upon the individual performance of those countries, whereas the euro is a currency that's superimposed on various nations. So to what extent can the euro be stabilized short of the integration of those countries into really a united Europe? There's nothing that essentially balances it like we do with the individual states in this country to make one nation.
The way I put it in the book is that the euro is a currency without a state. The renminbi is a currency with too much state. So there are problems of both kinds. I wouldn't embrace the language that the euro is imposed on a group of countries. It was voluntarily adopted by a group of countries that are still wedded to it. But there is a real substance to your question about how can Europe complete its monetary union in the absence of a unitary or federal state. The way I think about it is that Europe has shiny coins and beautiful banknotes and a more than adequate central bank, but it doesn't have the other elements of a functioning monetary union. And for the project to succeed, Europe needs to move now, as I believe it will, to put those other elements in place. What are they? Number one, I think the crisis in Europe and the problems of the euro are fundamentally a banking crisis. And the fact that bank regulation is being done at the state level rather than at the euro area level is part of the problem. So they need to fix that. They need an honest broker to call things as it sees it in terms of which banks are weak, which are strong, which need to be recapitalized, which need to be closed down. And the European Commission or another independent agency at the level of the euro area needs to do the supervision and regulation of the banking and financial system. And with the banks strong, they can get around to the debt restructuring they need to do. They need a proper emergency financing facility. Emergencies happen, as we learned in the United States in 2008, and Europe didn't have a proper mechanism for providing those temporary financial transfers that I was talking about before. So there's now agreement to create a permanent European stability mechanism in 2013, but it isn't yet adequately in place. The bridge facility in place now is undercapitalized. But to my mind, those are the essential things. That's all Europe needs to do to secure its monetary union. And it would be possible to do those things in relatively short order. I don't think Europe needs to become a federation in order for the euro to work, but I would acknowledge that the kind of experiment on which Europe has embarked, a single currency for a set of sizable sovereign states, is unprecedented.
Yeah, oh, fine, thank you. Robert Shaw, you've said that you think that if the dollar ceases to be really the only reserve currency, international reserve currency, the competition among, say, 3 reserve currencies would impose more fiscal discipline on us. Do you think it would have any benefit in the area of major trading countries not using their currencies and exchange rates as a means of controlling trade flows? Or do you not see that as an advantage of having more than one main reserve currency?
I do agree that problems are created by large chronic surplus countries continuing to peg their currencies rather than allowing them to adjust. I do not think that moving to a multiple international currency world will automatically eliminate or solve that problem. But insofar as what I'm really talking about here is China. If China is serious about internationalizing its currency and making it attractive as an international and reserve currency, and it therefore opens its financial markets as a necessary prerequisite for doing so, it will have to let its currency fluctuate more freely. So at least one manifestation of the problem you're describing will go away, I think, in the course of this transition. Will the more general problem that a bunch of countries around the world are reluctant to see their currencies rise against the dollar go away? No, I don't think so.
Okay, I'm Jean Ergos. Thank you for an excellent presentation. A very simple question, which is this. You spoke about the end of the dominance of the dollar and what could happen in that event. What is the number? I mean, at one point, how do we measure this end of the dominance of the dollar? You mentioned that 85%, if I'm mistaken, of world trade transactions in dollars. A lot of that, I think, is going into crude oil. I mean, I myself worked in the industry for many years. What is the trigger point? When do we say the dollar is no longer dominant? This can happen. Is it a question of the amount of trade flows denominated in dollars? Is it a question of a critical interest rate level on the 10-year Treasury bond, which provokes a crisis like is being rumored in Europe about certain yield levels? How do we actually get our hands around this? I'm an economic advisor. I work with an asset manager. This is very important for me to have an idea of how this works.
Well, I wish I could make your life simple. The problem being that international currency status has multiple dimensions. We will see over time the share of international reserves held in the form of dollars go down. We will see the share of trade that is global exports and imports that are invoiced and settled in dollars go down. We are seeing the share of foreign bonds that are denominated in dollars go down. But some of these things can move more quickly than others. China is taking over, China's currency is taking over from the dollar more quickly in the realm of trade invoicing and settlements than in these others. That comes first. China is moving next, but more slowly, to encourage foreign central banks to hold some of their foreign reserves in its currency. The Central Bank of Malaysia has already moved in that direction, and others will follow. Private finance will be the caboose on the train. So what I'm saying is there isn't a tipping point where, one morning where you should wake up and say, sell, sell. Or at least the kind of economics and economic history that I do doesn't point to a particular day.
Thank you for your very clear exposition of very complex issues. And I think that must explain why you've won so many distinguished teaching awards. As an international business person, there's something about going away from the dollar that's very difficult. And that is, for most deals, one has to quote a price at the beginning of the year and live with it for the whole year. And it can be very confusing to have these exchange differences. How do you guarantee your margins? But the major question is that you haven't had a chance to deal much with the internal Chinese economy. We're reading so much about it. And how is China going to satisfy the consumers of its enormous population? And it's now concerned with inflation. So what kind of stability can the Chinese currency have?
So we could have a very long and rich conversation about the challenges facing China. They obviously need to, and they understand that they need to rebalance their economy toward domestic spending, domestic consumption spending in particular. They understand that as Chinese people begin to spend more on Chinese goods, on China's own stuff, the price of those Chinese goods will have to rise relative to the goods produced by other countries. That change in relative prices can occur in only three ways. Inflation in China. The Chinese understand, I think, that inflation can be socially corrosive because some people's incomes keep up with the rising prices and other people's don't. It could occur through deflation abroad, as like in the United States. And I think we understand that the Fed will do whatever it takes to avoid going there. Or it could occur through strengthening of China's currency relative to the dollar. So that's why I'm confident that we will see that. Again, as China's currency grows stronger, it will become in the perceived interest of more people to open those renminbi-denominated accounts at the Bank of China. It will be another step toward enhancing the appeal of China's currency globally. There could be potholes on this road. There could be financial problems in China emanating from the property market, lurking in the loans of the banks to Chinese construction companies or in other places. That could throw this process off course, so nothing is guaranteed.
Thank you very much, Professor Eichengreen. Karthik Shankaran. One of the arguments against Chinese renminbi reserve status has been that it's not convertible on capital account. Now, historically, until 1971, capital accounts were not freely convertible. They kind of became gradually convertible. Since then, you've seen a massive increase in capital flows relative to trade flows. Kind of the capital account tail wags the current account dog in some, according to some arguments at least. Now with IMF acceptance of capital controls for some countries, particularly emerging markets, do you think the process of capital account convertibility, free capital flows, just continues, or do we actually see a reversal in some sense where things become less convertible on the capital account, we go back to a more current account-driven world?
So the growth of capital flows has created severe discomfort for a variety of countries, most recently with very low interest rates in the United States. It's become profitable for financial operators to borrow here and invest abroad where yields are potentially higher, and that has driven up exchange rates, driven up stock markets, driven up property markets in a variety of emerging markets, which have responded in a variety of ways. They have let their currencies rise to make their investments there more costly for us. Some of them have tightened fiscal policy a bit to prevent their economies from overheating. Most recently, the Brazilians have tightened up on the regulation of their banks. And if all the aforementioned doesn't work, and they still have the problem, they resort to taxes or controls on capital inflows. Do I expect to see more of that? Yes, I do. Do I think that will roll back the process of financial globalization that we have experienced in recent decades that you've described? No. What the Brazilians have done is to put basically a 6% tax on foreigners who want to buy financial assets there. And they've limited the ability of the banks to access some sources of foreign currency funding. But if you still want to buy financial assets in Brazil, you still can. And my guess is that'll be true 5 years from now or 10 years from now.
Well, thank you. It certainly was an exorbitant privilege to have you speak to us this morning. So thank you very much for being with us.